is a narrow sideways range. Now, of course, I know narrow is subjective. You have to take narrow within not only the time frame, but also the typical personality of the pair. All right? I'll show you how to define these with a much more objective tool and do it quickly and visually in a moment, but I need you to know what these are to begin with. So you see sideways, quiet, low participation type markets, that's accumulation. The next cycle we'll talk about is markup. Markup's easy to discuss. It's an uptrend. Okay, we've seen a lot of uptrends in these markets. Certainly, if you take a look at this space and time, let's go ahead and go to a daily chart here of the Aussie. Everyone knew what the Aussie did for most of last year. This was an uptrend. For the most part, we had a series of higher lows. I know that a lot of people define uptrends as higher lows and higher highs, and truly, you do need both to have a continuation of any kind of movement higher, right? But to me, what I focus on in an uptrend are the higher lows or the support. The support in an uptrend is the backbone of the move. If you're looking at a downtrend, not hard to pick a downtrend out right now. You can just look no further than the Euro-US dollar. That is a series of lower highs. Okay, the resistance is the backbone of a downtrend. Of course, we want the lower lows to see that continuation, to see that push lower, to see that bearish sentiment. But the backbone of the downtrend is also called a markdown cycle, is that resistance, are those lower highs, okay, the downtrend line resistance itself. So we have accumulation, we have markup, we have markdown, a little bit of definition of what I look for in each one of those. And finally comes distribution. Distribution is a tricky market cycle. And I'm just going to try to scan through and see if I can find a distribution market cycle. Distribution is probably easier to recognize by what it's not than going about looking for what it is. So let me explain myself. If you have a market cycle that is strong enough, heading higher or lower, that you can say, yes, this is a trend and it's defined by such with this tool I'm about to show you here in a moment, then you know you don't have distribution. You have the markup cycle or markdown cycle. If you have a quiet, range-bound, sideways market, okay, you can identify that by the reliability of the support and resistance and by the narrow range that you're seeing. Distribution essentially becomes that market cycle that's left. In other words, if you don't have accumulation, if you don't have a trend, you will be most likely left with distribution, which is a confused market. Distribution is basically the exchange of, in our case, the lots, the Forex pairs, the idea that one group of traders is getting out of a position while another group of traders is getting in. There's a lot of confusion about whether the trend will continue. Okay, it's usually where the latecomers get to the party too late. The traders who are in the trend much earlier are getting out, and there's this wide range volatility that accompanies this wide difference of opinion. Some people are dumping, some people are buying, or vice versa. Either way, it creates confusion. Okay, so if accumulation can be really best explained to as no opinion or boredom, distribution is most ideally described as confusion. So if you were to break this down into the moods of the market, an accumulation is boredom. A markup is classic greed. A markdown is classic fear. And distribution is confusion. If you cannot identify the psychology of the time frame and of the pair that you are preparing to trade, that you are setting up for analysis, in my opinion, you probably will not apply the correct strategy to the market. Because, give or take, most of us in this room will probably draw very similar trend lines and identify very similar support and resistance levels on the chart. So it's not the identification of support and resistance that distinguish us from one another. You know, identifying these levels isn't the big key in what separates one person's trading from another. It's what we decide to do at that level. Given a support or resistance level that all of us are looking at, the room might be split down the middle as to those people who are expecting a breakout and those people who are expecting exhaustion. Okay, so some people decide to sell at a certain level, some people decide to buy at a certain level, and that's what makes the market world go round, this difference of opinion. But we have an opinion usually at very similar price levels. It's what we think that level means. Well, the meaning behind a level goes back to what the underlying psychology is. Okay, now if this hasn't made complete sense yet, hang with me. Okay, we're going to keep moving forward with this idea because it's going to absolutely apply to the way we use chart patterns. Okay, all right. Let me also talk another huge, monumental shift in my trading, and this came from, again, it was born of this idea that I needed to know the market cycles, as Charles Dow taught them. I developed a trading tool. I shouldn't say developed because it's more like putting together a trading tool that's very unique for this specific idea of market cycles. And in order to utilize this tool right, there's this concept of market memory or look back that I need to share with you.